extraordinary for issuers. Well, so what do I mean by extraordinary? Why the hell are people doing this? From an issuer perspective, this started off with getting new investors, and it's still a dominant idea. Because you get higher subscription rates, you're likely to get new investors. That makes sense. However, is that enough to make the changes that we need to make and to mobilise the level of capital that we need? Noting that McKinsey says we've got to get about $10 trillion per annum moving to address climate. And we're about to hit the magic figure of green bonds of $1 trillion a year, but that's still a long way off. Green bonds are only a slice of it. There's equity, there's government spending and so on, but you get the idea. Well, the growth rate continues apace. Green bonds will grow about 30% this year. And the benefits are generally palpable. In my experience around the world, issuers tend to take a long time to decide to issue. A government will often take 2 years for humming and hawing, which is a good idea. But once they issue, they get terribly enthusiastic. And the biggest challenge we face is with issuers finding enough things to finance, to qualify. Come back to what qualifies in a minute. They can't grow their programs fast enough. So every sovereign green bond program would like to issue many more, but they're having to push their other ministries to get their act together to find more projects they can. The green program, and that applies to corporates as well, and munis as well. The market has developed such an appetite for these things that it has driven some price differential, which is now beginning to draw in a new crop of issuers who are concerned primarily about the pricing. So the way this works is not sentiment. It's not about people saying, I want to save the planet, therefore I'll take a haircut. On the contrary, in secondary markets, green bonds perform better. It sort of makes sense. Every time there's a downturn in the market, some politician puts out a tweet and the market crashes, then we find green bonds hold their value. Now, there's a famous quote by Larry Fink, head of BlackRock, who said he didn't make money by giving his investors yield. He made money by ensuring his investors didn't lose their money. For fixed income investors, the area we work in that dominate institutional investment portfolios, value retention is the critical thing. It's the most important thing, avoiding losses, which is understandable. They want to make sure that if someone retires in 2 years' time, they're going to be able to pay it out. If the valuation of the bond portfolio has gone down, it's going to be harder. If they can ensure sustainable valuations, it's an attractive feature, and that's driven secondary market performance. So green bonds trade at a premium, we call it a greenium, in the secondary market. That in turn has driven stronger primary demand. And we typically see a greenium, we call it in the primary market, a differential, let's just say, a modest one, but a material one if you're a large issuer. This is not material at all if you're issuing $1 million or $10 million muni bonds. But if you're issuing $100 million to $500 million to $1 billion bonds, this becomes very material. The UK government, with its inaugural sovereign green bond, saved £28 million on the green format versus the vanilla format on their first bond. And they've gone on to have advantages like that going forward. Of course, the real benefit for corporates is the nature of investor engagement. Pricing becomes a bonus feature if they get it. It's not the driver. Now, I do get corporates to say, well, show me the price and I'll do it. And I tend to say to them, don't worry about it. If you're a treasurer and you don't understand the deeper engagement with investors is a benefit, then you probably shouldn't worry about this. Look at something else. But to give you an example of how the deeper engagement works, I had a conversation with the treasurer of Hydro One in Canada last week, who was saying that when they did their green bond, they've done about $6 billion now of green bonds, they found that their share registry changed. So they've now got about 40% European investors who like the green format. So in other words, a flow-on effect of equity. In Europe, research has shown that people who issue green bonds, corporates who issue green bonds, typically the stock price bounce, and it stays. Not huge, but it's noticeable on the data. These are the kinds of ongoing benefits that come with strong investor engagement. Look, we've got a fantastic market. It's grown enormously over the years. There is lots of potential. There are palpable but small price benefits in the US market to such an extent that for municipals, one of the slices of the green bond market in the US, who are often under legislative requirement, legislative constraints to find the lowest possible path of issuance. If they're not looking at the green bond path, they are not looking at the lowest cost way of issuing bonds. They're being negligent. And this is an interesting challenge when you've got some states in the US saying, no way, Jose, we don't want to get involved in that. But if the price benefit is clear, there is a legal requirement to start looking at these other things. But that's just an aside. The variations on the theme that are coming through the system now. This started with green for renewables. We managed to turn it into a much broader market over the last 15 years. Electric rail, electric vehicles, water investments, and a whole range of things. San Francisco Public Utilities Corporation has been issuing water bonds for 10 years, for example, which is energy efficiency and also resilience, as in preparing to reduce wastage to better survive the droughts that San Francisco Bay Area is having. Transition has been a big topic of conversation. We've been promoting globally the Climate Bonds Initiative, this idea that corporations and governments that need to start looking about how to reduce their emissions going forward and have a forward plan. In some jurisdictions, like the European Union, the UK, even the Philippines, transition plans for corporates are becoming mandatory. In other places, it's just something that investors are pushing hard on. How do we assess those transition plans? How do we bring bond issuance and, of course, other investments into the market for that? So we started seeing that around the world. So that's one major development. The key development there is if a company puts out a transition plan that meets independent standards for what are pathways to be achieved in the steel industry or the basic chemicals industry, then they can get a certification or label as a company, and all of their bonds can be issued. Investors who would otherwise stay away from high carbon companies can feel enthusiastic about investing in them because they're becoming green at a rapid pace going forward. But that third party review is what's really required there. A couple of weeks ago at the Climate Bonds, we launched our climate resilience taxonomy. You might be aware that 1.5 degrees, which has been the global target for some years, is going to be reached in a couple of years' time, according to the World Meteorological Organizations. We're still in a fight to get emissions down to avoid catastrophic outcomes, but we've got to prepare for increased heat. Well, we're starting to see that already in the US over the last summer, for floods, for increased hurricanes. It's not just Florida that's experiencing those, it's also Japan, and Mumbai is becoming a hurricane zone, etc. And the social and economic consequences of all that stuff. How do we prepare communities to be able to survive disasters that are going to come through now? So the resilience agenda is a very important part of what we now have to do. And investors are telling us now they're keen and happy and want to engage in that, and are looking for corporations to have adequately addressed adaptation and resilience issues. What does that mean? Well, it means if you've got a toy factory, that you've got some confidence it's not built in a floodplain. It's built in a place which is not going to be inundated very easily. So not so much Tampa, preferably somewhere like Phoenix, for example. But it can also mean that you've got factories that are designed in such a way they can have redundant stock to be able to feed the market if there are supply chain outages, as we saw in the pandemic, but as we see also with climate impacts. It might mean a corporation, or I should say a municipal corporation, that's doing work on ensuring that infrastructure resilient and also communities are better placed to be able to survive catastrophes, more resilient. It might simply mean distributed energy, which ensures that if the power line goes down in one area or the grid goes down, as it did in Texas during that snowstorms a couple of years ago, that the different parts of the grid can keep working. They were not all redundant on the central grid falling over. These are resilience issues going forward. That's a new area of investment, and we are starting to see new bonds being issued. Mostly it's been water utility related bonds so far, but there's a lot more coming through. We expect to see around $3 trillion of resilience themed bonds within the green bond market in the next couple of years. There's an enormous opportunity for issuers that are doing things that are consistent with addressing climate action to issue and take advantage of this market. For investors, they see this as a way of signaling their concerns, addressing their liability side while meeting their short-term risk yield portfolios. It's a win-win situation. And for policymakers, this is turning out to be proof that investors will invest if you do a certain minimal level of fiscally efficient policy and regulatory measures. And for that reason, we've now got engagement around just that issue, what are fiscally efficient policy measures globally, all around the world. We have measures happening in Japan, in Singapore, in Brazil now under the current presidency, which are to encourage investment without necessarily going to the state subsidy area. Of course, we've also got the big kahunas. We've got the Inflation Reduction Act in the US. We've got the GX plan in Japan. We've got the renewable energy support in China as well, all of which is providing more opportunities for green bond issuance. That sort of virtual circle, proof of concept, and as well as that, enthusiasm on the part of governments to act, which is fundamentally what we're trying to do. The challenge we face is extraordinary. $10 trillion a year, as McKinsey said, is not a small amount of money. We do have the capital, just to be very clear. It's not about a shortage of capital on the planet. We're awash in capital in a way the planet has never been before. But of course, it's misdirected in different sorts of areas. The green bonds market is proof that investors will invest if they're given the opportunity. The challenge we face globally is very much finding issuance, finding supply, finding bonds for investors. We could place 10 trillion tomorrow if only you were able to give us more product in this market. That's the opportunity. Hey, we're not going to save you 10% on your interest, but you will get savings and you'll get increased investor engagement. For all of us who are citizens, this is incredibly helpful because it shows us that the capital move, there is a framework, a protocol, an approach here to make the capital move, which is what we need to do to be able to address this extraordinary challenge that we face as a species, as a planet, as an economy. I'm hopeful. I mean, I'm sanguine, 1.5 is about to be reached, things are going to get ugly, but the super tanker of the world economy is turning, and green bonds have been a big part of that engine of making it turn.
And getting bigger and going into new areas. Sean, thank you very much. I think it was a very comprehensive talk. We appreciate this very much. Good to see you again. I was at the event you put on over at Fitch. So I did hear that, the new taxonomy. So thanks for contributing again to the Wall Street Green Summit. Thank you very much.
Thank you, Peter. Thanks, everyone.
Okay, bye-bye.